The intrinsic and extrinsic value of options is something that options traders need to know. It is a fundamental concept. So I'm going to talk about the 3 things that option traders need to know about intrinsic and extrinsic values. Let's get started. The first thing that we need to know about intrinsic and extrinsic value is this. Extrinsic value is the price of hope or fear. I'm pulling out this options chain from SPY. I'm taking a look at the 35 days to expiry options chain. I'm going to pick 2 options. One is in the money and one is out of the money. Both of them are roughly equidistant from the underlying price of 304. The price of the options can be further broken down into extrinsic and intrinsic values. So let's take a look at how to calculate these things and why they are important. The price of the out of the money call option is completely made up of extrinsic values only, whereas the in the money option comprise of both extrinsic value and intrinsic value. To calculate the extrinsic and intrinsic value, what I need is the underlying price of SPY. So as you can see, the underlying price of SPY is $304.21. The strike prices are also important for calculating intrinsic and extrinsic values. So the strike price of the in the money option is 300, the strike price of the out of the money option is 308. The intrinsic value is calculated like this. Taking your underlying price, which is $304.21, you subtract away your strike price of 300. As an options buyer, we can exercise our right. By paying $300 to buy SPY, I can then immediately sell it for $304.21. Therefore, by exercising my option and selling it immediately, I have a profit of $4.21. This $4.21 is my intrinsic value, which means to say the value of my option right now, if I exercise and then sell, is $4.21. It is material value that I can get. In short, that is what intrinsic value is. Intrinsic value is what is the value of my option if I convert it into stock. Unfortunately though, the intrinsic value of the option is far smaller than the price of the option. The price of our in the money option is $13.01. The intrinsic value is only $4.21. So what is the rest of the value of this option? The rest of the value of this option is our extrinsic value. So what then is extrinsic value? Extrinsic value would just be what I call fluff. This fluff, this extrinsic value, is basically the price we pay for hope or the price we pay for fear. It is a price we pay because we don't know what the future will hold. It is the price of uncertainty. The more uncertainty in the future, the more fluff there will be and the higher the extrinsic value will be. So when we pay $13.01 for this in the money option, the actual stuff that we have, the intrinsic value, is only $4.21. The remaining $8.80 is just hope. We are paying for that hope. So if you're thinking, hey, this fluff looks expensive, well, you're right. Extrinsic value is expensive. The more extrinsic value there is, the more the underlying has to move in order to make up ground to a point where we make a profit. So logically speaking, the less extrinsic value there is as an options buyer, the better off we are. So just to compare extrinsic value and intrinsic value again. Extrinsic value is an illusion. It is the thing that we cannot hold on to. It is just hope, it is fear, it is irrational, it is uncertainty. You can't hold on to it. But intrinsic value is substance. You can immediately exercise your option and then you can sell it and you immediately get a profit of $4.21. It is substance. So extrinsic value and intrinsic value can be compared as an illusion versus something that is substantial. What about our out of the money option then? Well, the out of the money option has a strike price of 308. The strike price of 308 is higher than our current underlying price of 304. Would we choose to exercise our option then? That doesn't really make a lot of sense because if you exercise your option, you're paying $308 for the underlying. But right now the underlying is only 304. Why would you want to pay more money for an underlying than it is worth in the market right now? Nobody would do that. Therefore, the intrinsic value will not be a negative number. Intrinsic values will only go to 0 because it doesn't make any sense for somebody to exercise their option only to sell it immediately at a loss. 100% of the value of an out of the money option is extrinsic. It is completely fluff. So buying out of the money options is completely buying on extrinsic value. You are buying hope, or you are buying on fear, or you're just buying on uncertainty. It is really no different from buying a lottery ticket. Here's the second thing you need to know about intrinsic value and extrinsic value. Extrinsic value starts to evaporate as we get nearer and nearer to expiry. Yes, it starts to evaporate. This particular option chain is taken on the same day as the previous. But the difference here is this options chain expires within 7 days. The previous one expired in 35 days. Once again, we should visualize the options in terms of extrinsic value and intrinsic value. The in-the-money option has both intrinsic value and extrinsic value, but the out-of-the-money option only has extrinsic value. Because I'm taking the exact same strikes, the strike price is 300, the underlying price is the same at 304.21, and hence the intrinsic value is the same, it's $4.21. But you can see that the difference here though is that $4.21 is a much larger proportion of the entire option's price. Therefore, comparatively, this option at 7 days to expiry has a lot less fluff and a lot more stuff. But how then do we explain this? Why is there less extrinsic value the nearer we go to expiry? The reason is this: with only 7 days left before the option expires, there's a lot less uncertainty to be decided within 7 days. Is the underlying going to rise in the coming few days? If it rises, how much more will it rise? Because there are only 7 days left, it's much easier to foresee how much it will rise compared to one that has 35 days remaining. Therefore, the less days there are to expiration, the less uncertainty there will be. The less uncertainty there will be, the less extrinsic value there will be. The same is true for out-of-the-money options. Because the out-of-the-money option has zero intrinsic value, everything we see in the out-of-the-money option is extrinsic value. You will notice though that $3.44 in extrinsic value is far less than what we saw previously. Therefore, with less days to expiry, the extrinsic value of the options will drop. But the intrinsic value of the options stay the same. Remember that the intrinsic value of the option does not depend at all on the option price. Intrinsic value depends on the underlying price and the strike price. As an options buyer, if you want to buy options on the cheap, you should buy options nearing to expiry, because you'll be paying far less for extrinsic value. You're paying far less for hope and fear. Here's the third thing you need to know about intrinsic and extrinsic value. At-the-money options have the most extrinsic value. I have chosen 9 different strikes. 4 of them are in the money, 4 of them are out of the money, and 1 of them is at the money. The taller the column, the more expensive is the option. Clearly, the in-the-money options are more expensive. That we already know. But you can also see that the solid brown portions, which is the intrinsic value, starts to increase further and further as we go into the in-the-money options. Because we are able to calculate the intrinsic value, let's subtract off the intrinsic value from these columns and have only the extrinsic values remaining. And what we see is that the at-the-money options has the most extrinsic value. We are paying the most for fluff, we are paying the most for hope and fear if we buy an option at the money. So this is something for options buyers to really consider. As an options buyer, we might be thinking we want to buy an option that's near the money. The logic goes that I only require the underlying to move just a little bit more, and then I will go in the money and then I will be in profits. But that's not necessarily the best way to do things, because if you're buying at the money options, then you have the most extrinsic value that you have to overcome. Remember that as time gets nearer and nearer to expiry, your extrinsic value will start to evaporate. When you're paying so much more for at-the-money options, there's a lot more extrinsic value to evaporate by the time you start to reach expiration. Hope or fear, and it may not be realized at all. Extrinsic value is expensive. 2. Extrinsic value starts to evaporate the nearer you go to expiry. So you might be thinking, I'm going to buy a leap option that would expire sometime next year in over 200 days. But now, armed with this information, you really want to think twice about that, because you'll be paying a lot for extrinsic value, and this extrinsic value will slowly start to evaporate day by day. And the third thing is that at-the-money options have the most extrinsic value. If you're going to choose to buy at-the-money options, then choose to buy them very, very near to expiry. If not, stay away from at-the-money options. Go for deep in the money options if you're directional. So options traders, I hope you found the information in this video useful to you. Until my next video, see you again soon.